I should say. Joining us now is Ryan Lamont, CEO and co-founder of Neovision Wealth Management. Ryan, really good to have you with us. I guess when you think about the knock-on effect that this could have to markets, the direct channel is the energy shock that it's causing right now in the world. How would you describe this moment in history vis-a-vis other energy shocks that we've seen in the past?
Well, the only reference I have is 1973, obviously, where 7 or 8% of total oil and gas production was cut off from the West. So if we look at today, it's almost 20%. So that's more than the double of what we have seen in 1973. I think markets today are not pricing adequately the length of the current war, because as long as it lasts 2, 3 weeks, 4 weeks maximum, it's still recoverable. But if it lasts longer, and this is what happened in 1973, the pain in 1973 is not only the 7 or 8%, it's the length of the blockade that happened back then. If this extends over several months, then yes, this can have devastating effects on financial markets, I think.
Why do you think the S&P has been relatively resilient compared to European and Asian markets here?
So the S&P 500, if you graph it against oil prices, inverse, if you look at the inverse correlation between the two, they've been working literally in lockstep. Now let's look at oil prices. If you look at oil futures, because this is what everyone looks at, oil futures today do not reflect where oil prices are, because today there are a few tankers passing through the Strait of Hormuz every day or two, and mostly going to China. The actual oil price is around $140, and users of Bloomberg can actually use their terminal to see that FSDUMO index and then go, and they can see the fair value, the actual price at which oil is trading. So futures today do not really reflect where oil is and the stress that we're witnessing on oil. And because S&P is moving in lockstep with oil prices, this is why S&P has been relatively resilient, though tech is down 10% from the highs.
Ryan, for as long as I've been speaking to you, you've been a gold bull. And I'm curious to see your thoughts on the lack of performance of gold since the war broke out. And also, silver is down almost 10%, I think, since the start of the war. What's going on there? Why is it not acting as you would expect it to behave in a time of geopolitical crisis?
Well, we are not in a geopolitical crisis. We are in a war, literally in a massive war happening here in the Middle East that has the potential of expanding further out. So we have other shipping lanes that can be closed here in the Middle East. So this could have really much bigger proportions. Now, when this happens, people tend to run to cash. And this is why the US dollar has been an outperformer, because people have they want to hold cash. Cash is king in these situations. So we dump assets and we hold cash. All bets are off. We are in a BCP mode from a financial market perspective. And this is why you see gold, like many other assets, are underperforming, or they lack performance, if you will. And US dollar is the winner in this. And this is exactly what we're doing. We're sitting on the sidelines, We're waiting, and we're holding on cash.
Yeah, would you hold the USD here? To your point, the dollar actually has done quite well in the last couple of weeks.
Well, it's more Swiss franc for us than US dollar. Would be much more comfortable in the Swiss franc, because we believe that US dollar could exhibit some very high volatility. If the situation gets resolved very quickly, yes, we can see US dollar weakness again. If it continues for much longer, we can see more strength. So for us, it's much safer to hold Swiss francs than US dollar.
And let me just round things up. On a typical week, we probably would have started off our discussion around this, but we've got the Fed meeting coming up on Wednesday. What are you expecting to hear from them? And is it going to be the case that the hawks will be back in the driving seat?
Oh, 100%, because when you have an oil shock, it's a diffusion problem. Oil shocks generally feed into direct inflation. We've seen this before, and this is what will happen today. So the diffusion is happening. Consumers are starting to feel it at the pumps. This dries up liquidity, and this will have an effect on financial markets. So the potential return of inflation will definitely bring back hawks, and I do not foresee any cuts, and I'm starting to potentially think of hikes even.
Okay, well, we'll leave it on that cliffhanger. Ryan, we'll save that for the next conversation. Ryan Lamond, Neo Vision Wealth Management CEO and co-founder. Well, coming up, oil markets are set for a tumultuous week as the U.S. attack on Iran's Karg Island raises the stakes. We discuss the impact with Matt Stanley from Kepler next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Oil fluctuating this morning after Iran